In this opportunity, we are going to talk about the relationship between real estate valuation and the capital asset pricing model. The capital asset pricing model assumes operationally efficient markets. This means frequent transactions and no significant barriers for trading. Unfortunately, there is evidence that the property market is informationally efficient, but it is not operationally efficient. For this reason, betas are not easy to calculate, are not very reliable. Also, property has risks which cannot be measured only through volatility. The returns on property actually demand the inclusion of other moments. For all these reasons, the Capm is not generally used for real estate valuation. In spite of these problems, there is an interesting proposal to make the Capm applicable for the valuation of income properties. The proposal requires taking advantage of REIT prices. What are REITs? REITs are real estate investment trusts. They are the most important real estate investment funds. They are regulated mutual funds, like mutual funds, regulated societies, regulated mutual funds, whose benefits are tax exempt at the firm level. Only shareholders pay taxes. REITs are usually leveraged. The average leverage for REITs is in the order of 50% in loan-to-value terms, meaning loan-to-value meaning debt divided by assets. Also, REIT stocks are generally quoted in the markets. So, REIT investments in property are much more liquid than the direct real estate investments. And this is precisely the key behind this proposal. At present, about 15% of real estate assets are in REITs. Let's look at the proposal, which was developed for the US market. The method is based on US REIT series at the national level and also by product and by local property market. The national beta is calculated with respect to the Standard & Poor's 500 index, whereas product and city betas are calculated with respect to the REIT National Return Series. The result is a weighted beta formula that we show here. So the beta of a particular REIT is equal to the product of the national beta by the product beta by the city beta. Now we show the results that were obtained for the US market, starting with the national beta and the product betas. At the national level, the beta is equal to 0.47. And for the different product markets, we have this series of betas. The office market, 1.07, industrial properties, 0.87, commercial properties, 0.88, residential properties, 0.75, hotels, 1.67. And at the city level, the following results were obtained for different cities in the United States. For instance, Boston, 114, Chicago, 0.76, etc., all the way down to Washington, D.C. We notice that there are substantial differences in city betas. If we pay attention, for instance, to the Boston beta and compare it with the Washington beta, we see that the Boston beta is much larger. Well, the reason for these differences stems from the relative instability of the main local businesses in each city. In the case of Boston, the main business is finance and high tech, and these are intrinsically unstable businesses, whereas Washington depends primarily on government activities, and government is an activity which is very stable. Well, we know that REITs are leveraged, and we know also that the average level of the leverage of REITs is 50% in terms of debt over assets or loan to value. In consequence, beta will have to be unlevered. If we calculate beta using the formula that we showed before, this is a levered beta. So in order to be applied to a particular income property, it will have to be first unlevered. Let's illustrate with an example. We will compute the unlevered beta of an industrial building in the city of San Luis. Here we have a table in which we just copied the betas that were obtained for the US market, the ones I explained before. We have the following assumptions. The average leverage of REITs is 50%. We assume that the beta of the debt for REITs is 0.1, and we know that the tax rate for REITs at the firm level is 0%, as we explained before. In order to calculate unlevered beta for this industrial building in San Luis, we need two formulas. First, what we call the combined beta formula, the one that we explained before, and the other formula is the formula that is used to unlevered beta. Here we see that the unlevered beta, beta A, beta of assets, is equal to beta of equity plus beta of debt, multiplied by 1 minus the corporate tax rate, multiplied by D over E, the leverage ratio, measured in a different way, and everything divided by 1 plus 1 minus TC, multiplied by D over E again. So the first thing that we do is that we calculate levered beta. Levered beta, in this case, is 0.368, and is obtained from the combined beta formula. So it's the result of multiplying the national beta, 0.47, by the industrial beta, 0.87, by the San Luis beta, 0.9. So the result is the levered beta for an industrial building in San Luis equal to 0.368. Next step is to unlever this beta. To unlever the beta, we use the formula for levering and unlevering beta, the formula that we show at the bottom of this presentation, of this slide. Notice that this formula includes a beta for the debt. Usually when we lever and unlever betas, we ignore this. We assume that the beta of the debt is 0. In this case, in the case of real estate, it's better to include the beta of the debt, because it is very common in the real estate business to have a beta for the debts which are larger than 0. In this case, precisely, we are assuming a beta for the debt equal to 0.1. So if we apply the levering beta formula, we obtain this value for the unlevered beta for an industrial building in San Luis. It's 0.234. What can we conclude about this presentation? Well, a method was presented for the application of the capital asset pricing model for income property valuations. Unfortunately, only rarely the Capm is used today for discount rate estimation in the property sector. As was mentioned before, the main reason is the difficulties of estimating beta because of the fact that the real estate market is not operationally efficient. Also, we know that property has risks that go beyond volatility, that cannot be measured only through volatility. For all these reasons, the Capm is usually not employed in property. Given that the only public information that is available in the property market is on gross yields for commercial property, the common practice is to use these gross yields as a proxy for the discount rate. We will discuss this option in the next video. Also, we have ignored up to now development projects. The valuation of development projects will also be treated in a future presentation. And that is all that I want to share with you today. Thank you.